Hello and welcome to the Investing IQ podcast. I am your host, Chris Reed, and this is episode number 8. Main talking point today, what is inside your 401k? We'll go over that in just a few minutes. But before we get started, we'd like to tell you guys about Root Car Insurance. Part of investing is having money to invest. So look for ways to save money, and I'm telling you, Root Car Insurance is something I wish I found a while back. I've been using it for about 6 months, and we're able to save around $1,000 on our car insurance. It's a pretty slick app. What you do is you download it, and they use artificial intelligence to gauge how you drive, and it takes about a week and a half, 2 weeks of them tracking how you drive, and then they put the analytics to work and give you a quote within, again, just about 2 weeks. And I've really enjoyed having Root. There is a link in the description box on all the podcast platforms as well as our new YouTube channel. So make sure to check the description box on YouTube as well as the podcast platform channels for the link to Root Car Insurance and save up to $1,000 a year on car insurance. All right, to start out, we're going to take a look at the overall markets. Today is Friday, ending out the week. What a bloody Friday we are looking at here. Looking at across the indices here, NASDAQ, QQQ is down 1.47%. SPY S&P 500 is down 1.23%. IWM, which is the small cap ETF, down 2.78%. Dow Transports ETF IYT is down 1.6%. So across the board, after a huge move yesterday, on the heels of Wednesday. So Wednesday has caused a lot of chaos in the markets. Wednesday, the Fed kind of came out and stayed dovish. So for those that are new to kind of Fed talk, dovish means that their trajectory for interest rates and interest rate hikes for the year, they pulled back on that. They've pulled back about as far as they can go compared to where they were just a few months ago. But basically, they're saying that they're going to have patience in raising rates this year. You had the numbers slightly in favor before the Fed talked. The numbers were in favor of the Fed raising rates once this year, but that has pulled back after their data or after their language was released on Wednesday, to the point where now we are expecting no rate hikes this year. Inflation is really low, and really they're not trying to fight inflation is one of the biggest things. And there's other things to talk about when that's concerning the interest rates, but we won't get into that right now. But that's what happened Wednesday, and then the market liked it, and then it pulled back, and then Thursday had this huge up move led by Apple and tech, and then today it's given all of it back. I mean, yesterday was one of the biggest up days in technology stocks in a couple of weeks, and then today it gave it all back, and potentially more. So it's kind of bouncing at the lows from yesterday. If you're looking on YouTube, we're on the 3-minute chart on QQQ. So the lows was 178.82. We're sitting at 179.92, about a dollar bounce. So it's very interesting as what's going on. Just a couple things wanted to mention. Again, if you're not, we just started our YouTube channel, and if you want to have a visual with what you're hearing on the podcast platforms, because we are on a number of different podcast platforms, including Apple Podcasts, Google Podcasts, Spotify, Stitcher, Overcast, just to name a few. But if you want to put some visuals with what we're talking about, to kind of give you a better picture of what's going on, check us out on YouTube at Investing IQ. But if you take a look at the QQQ chart right now, and we go out to the weekly again, where we keep talking about this potential head and shoulders, the tech stocks have blasted through the left shoulder level, which was around 175, so about 5 points above. But if we don't break above the all-time highs, that's considered significant weakness. Now, if you go to IWM, I want to look at IWM real quick, which is small cap stocks, and then we'll look at IYT, which is transportation stocks, as we talk about the Dow theory. But small cap stocks tend to lead the market, and it really shows you what investors think about the riskier assets. So the small capitalization stocks, typically you're talking about companies less than $2 billion in market cap, and they carry more risk than large capitalization companies. So it's interesting that IWM, which tracks the Russell 2000, is very, very weak and much weaker than the overall market. And this IWM got broke down right at the left shoulder that was created at the beginning of 2018. So it did not break past that 160 level. In fact, it got rejected right at 159. So right at that left shoulder level, the right shoulder was created, and we are in a head and shoulders pattern pretty definitively on IWM. Same with IYT, the transportation index, down 1.5% as mentioned earlier. It's been in a downtrend, and this has to show strength above the trends. This trend line that is showing right now, where it got rejected this week around 188.50, but it does need to break back above that for the industrials to confirm the Dow theory, where the industrials and the transportation sector is moving in conjunction with one another. There's been a false signal where the industrials broke out, the Dow 30 is what you hear about all the time on the news, but the transportation index, which is not talked about nearly as much, has not shown that type of strength. So small caps are weak, transportation index is weak, and the transportation index is not following the strength of the industrials to the point the Dow theory is still showing a sell signal. The other thing today, that one of the biggest news pieces, there's an inverted yield curve that's happening, and the 2 and the 10-year Treasury yield curves, they're not inverted quite yet. It's getting very, very close. I believe the spread was around 0.14 at the end of the close yesterday, but the 3-month and the 2-year inverted, and that's very significant. That has not happened since 2007. And when you have shorter term interest rates inverting with longer term interest rates, such as the 3-month compared to the 2-year and the 2-year compared to the 10-year, that signals a recession and a slowdown. So that's something to keep in mind. I'd like to do a podcast to get more into detail about that. But that's something to keep in mind, and a lot of people are watching that, and that got inverted today, and that's what caused this mini sell-off, we believe, and bonds exploded to the upside. If you're looking at tracking some of these bonds through ETFs just to watch price action, I'd recommend taking a look at JNK, BND, TLT, and that kind of gives you a little widespread there of the different yields that are out there inside of ETFs. Also, we are on Twitter, Investing IQ. Make sure to follow us on there. We'd love to interact with you guys, and send us questions on Twitter. Feel free to tag us. Again, Investing IQ on Twitter. You can also send us an email with any investing questions that you have. Also, trading questions as well. Could be about charting. Could be about scanners. Could be really anything you guys are taking a look at. You can send an email to investingiq1@gmail.com. Again, investingiq1@gmail.com. So main talking point today, what is inside your 401k? What is inside your 401k? It's really important to understand the fee structure that's inside your 401k. A fee structure ranges from 1% to 3%. And 3% is out of this world crazy. So if you're in that 2 to 3% range for fees and 401ks, you need to talk to one of your HR representatives to see what is going on. That should not be happening. You should be closer to the 1% range. But that's something to watch, is your fee structure inside your 401k. And also just make sure, just check and see what you're invested in. There's a story where someone was putting money in their 401k and it wasn't invested in anything. It was literally sitting in cash. And just make sure you know what's going on inside the 401k. Just contributing is not enough. So make sure you're going in, take a look at the funds that you're in. Take a look at the percentage of stocks you have, percentage of bond funds. I'm not a big fan of bond funds, but it is what it is. That's inside of 401ks. But typically, if you're younger and you have a riskier profile, then you shouldn't be in bonds. Again, not giving investing advice right now, just educational talk about the specific situations. But your situation is different than others, so make sure that you are talking to a professional about that. These are just general guidelines. But if you have 30 years of retirement, you probably don't want to be in a 50-50 split stocks and bonds. But again, everybody has their different risk profile, and you have to kind of figure out what type of allocation is best for you. But just make sure that you are invested. There are situations where the allocation isn't set up with the risk you're wanting to take, or maybe you're taking too much risk. Maybe you're at retirement and you're in 80, 90% or 100% equities, and you're trying to retire in the next few years. That's something that you're going to have to take a look at as we are finishing up the last part of this economic cycle, and we'll continue to talk about that over the next few episodes. Very important to get ready for an incoming recession in the next few years. Also, on your 401k, check and see if they have a Roth 401k at your employer. A lot of people don't realize that Roth 401ks have come on board the last few years. I think they have, as far as the private sector is concerned, there's about a 33% chance that your employer has a Roth 401k. It may be a little bit higher than that now. But Roth 401ks are great. They have the same contribution limits as the 401k, so you can contribute up to $19,000 as of 2019. And in your individual Roth IRA, you can only contribute $6,000. The catch-up would be $7,000, and the catch-up for the Roth 401k would be $25,000. So either 19 or 25 for the Roth 401k, or 6 and 7,000 for the individual IRA. But it's really nice to have that contribution limit. Then you also still get your match for the most situations with employers, but you have to check with human resources to make sure you do get that match. But the match, typically, you put money in the Roth 401k, you get the employer match, whatever that is, whatever percentage they match will go into your 401k and not the Roth 401k. That's something to keep in mind there. But typically, the younger you are, the more advantageous it is to use a Roth, or in this case, a Roth 401k. So do some research, talk to your human resources department, and see if you have a Roth 401k, and decide whether or not. Obviously, talk to your accountant. Always talk to your accountant on these types of situations. But talk to them to see what's the best situation for you, and see if your employer even offers a Roth 401k. So again, guys, follow us on Twitter. You can find us at Investing IQ. Send us an email, investingiq1@gmail.com, for any questions. We'd love to go over individual stocks that you're looking at, that you're potentially looking at investing, or you're just trying to do a fundamental analysis on it. We can take a look at charts as well on those individual stocks. Thank you all for the support for this podcast. And the way that you can support this podcast, there's a couple ways to do it. Obviously, follow us on social media, send us questions, follow us on YouTube now. You can, subscribe to us on YouTube and hit the alert icon to be notified when videos have been released. Please put a comment below as well on YouTube to kind of let us know what you want featured on these different videos. We do appreciate all the questions and all the support. You can also send us an email, as mentioned earlier, but just reach out to us on all those different ways. And we want to make this podcast as interactive as possible to help increase our investing IQ. Hope you guys have a great day. See you all in the next one.